All right, PPI comes out in about 20 seconds. We are looking for good old data that is going to hopefully reiterate the declining CPI we saw yesterday. Final month over month, we are looking for 0. We are looking for X food and energy of 0.2, X food energy trade of 0.3, year over year 3% PPI inflation, 3.4% year over year X food, energy, and energy trade, that is PPI X food energy trade looking for 3.8. Here we go. Oh, yes! Okay, big old Midas. Negative 0.5% month over month on PPI final. That's really good. PPI X food energy trade 0.1%. Let's go, baby. Inflation's going away. It's finally turning transitory. Look at that. PPI final demand year over year was expected to be 3.0, comes in at 2.7, also below expectations. PPI X food and energy was expected to be 0.2. We got negative 0.1. Let's go. This is great. Year over year, we did get PPI X food and energy matching 3.4, 3.4. PPI X food energy trade expected 3.8. We got 3.6. So we got big misses across the board here. Initial jobless claims were expected to be 235,000. We got a 239,000. We were looking at continuing claims of 1.833. We got 1.810. It does show a little bit of strength there still in the labor market, which is good though, because you don't exactly want a destroyed labor market and a destroyed economy, but you want inflation gone. But that's literally what's happening here. This is fantastic. This, in my opinion, reiterates, look, the Fed can hike in May and go away. This is great. We do not want inflation to stick around, obviously. And now keep in mind, and we're going to look at the PPI BLS in just a moment, pull it up. Keep in mind, I see this comment like every single day, but every single day I talk about inflation, I see people, but Kevin, I went to the grocery store and stuff is still expensive. Yes, we know, prices went up, but that is not what the Federal Reserve is fighting. The Fed is not fighting that things are expensive. The Fed is not fighting that things got expensive. The Fed is fighting that things are continuing to get more and more expensive. Right now, fortunately, that is finally transitioning away. Let's take a look at the producer price index. This is absolutely fantastic. Look at this. This month over month figure, keep in mind, this was expected to come in at 0. The expectation was 0.0. What we actually got was negative 0.5. This is really good. BLS final demand prices were unchanged in February, increased let's see, what is this here? Final demand prices were unchanged. February increased 0.4 in January. That is the... let's see here. Final. Okay, here. Producer price index for final demand declined 0.5% in March, seasonally adjusted by the BLS. Okay, then they go back into February, was 0.4, unchanged in Feb, and 0.4 in Jan. So what you're really seeing is sort of that declining in PPI. That's what they're really trying to show you here. 0.5. Here you had 0.4 in Feb. I guess it'd be the other way around, but I think you get the idea. And Kevin, wake up. 0.0 here in Feb. 0.4 in Jan. That's what they're trying to show you. And here we are in March. There we go. Okay. 2/3 of the decline in the index for final demand can be attributed to a 1% decrease in prices for final demand goods. There's that manufacturing side, right? There's that disinflation happening in manufacturing. In my opinion, that's your consumer staples. That's sort of your regular consumer products that people just aren't spending money on anymore because either they've hoarded enough of it or they're like, crap, if we are going to go into a recession, because now even the Fed's talking about it, maybe we ought to save a little bit of money. Prices for final demand, less food, energy, and trade edged up 0.1% in March after rising 0.2% in Feb. Right, that's fine. We went through those numbers already. That was expected to be 0.3. So the expectation for that number was, this number right here, was 0.3. So we pretty much missed on every side here. Let's see if we can get a little bit more detail here. Product detail, a 7.3% drop in margins for machinery and vehicle wholesaling was a major factor in the March decrease in prices for final demand services. Oh, really? For services, final demand services for machinery and vehicle wholesaling. That's really interesting because we've been seeing negativity on, what's it called? we've seen this negativity on products, but to see it on services as well is good. The index for transportation, freight, portfolio management, fuel, lubricants, retailing, loan services, automobiles, parts also moved down. All of those I just mentioned here, well, most of these, truck transportation, freight, portfolio management, those are all services, loan services, that's great. Prices for guest room rental rose 4.6%. Okay, guest room rental. What is that like almost like an Airbnb? Index for food, retailing, and transportation for passengers advanced. Okay, it's fine. So what do we got? Let's see here. Foods, energy, transportation, warehousing, fine. Processed goods and intermediate goods declined 1% in March after moving down 0.4% in February. A major factor in the March decrease was a 5% drop in prices for processed energy goods. Well, that's okay. I mean, we have seen, and this is why we purposefully look at some of these numbers excluding energy. Remember, final demand, not excluding energy, came in at negative 0.5%. And then when we exclude food and energy, we got negative 0.1. Exclude food energy trade, we got 0.1. And then same thing for the year-over-year numbers. But these numbers really came down nicely. Now, do keep in mind, we did get revisions for the prior release. So February did get revised up a little bit. Final demand went from, instead of negative 0.1 to 0. Food and energy went from 0 to 0.2, so you had some upward revisions here. Year over year went from 4.6 to 4.9. 4.4 on ex-food energy year over year went to 4.8. Ex-food energy trade went from 4.4 to 4.5. So the revisions are not that great. The revisions definitely hurt this report a little bit on the prior, but this is very good for this month at least. All right, let's keep looking here. Product detail, 1/3 of the March decrease in prices for processed goods for intermediate demand can be traced to a 6.5% decline in diesel fuel. That's okay. Again, that's why we exclude energy from some of the numbers. And even if we exclude energy, we get some big movements here. Let's see here. The index for unprocessed goods for intermediate demand moved down 5% in March, the largest decline since falling 9.7% in October. The broad-based decline was based on unprocessed energy goods, which dropped 11.5%. The index for unprocessed foods and feeds also moved lower. Fine. All right. Crude oil fell a lot. Fantastic. We know. China's reopening didn't pump oil like people thought it would. That's great. We also know that OPEC's price, or I can always say price, OPEC's production cut was really supposed to drive oil up substantially, which it did. I mean, Brent's at $87, and last month we were significantly lower. In the month of much of the month of March, we were sitting around $75, $75 to $78 for Brent. So we're going to be getting some reinflation next month because of these energy prices going back up this month, unless they start falling again pretty rapidly. But that might not be such a terrible thing because, again, we're looking at inflation numbers that exclude a lot of the energy numbers, and all of those missed pretty decently, which is good. Okay, let's see if we can get some more tables here so we can see some actual products. But this is fantastic news. This is a great point while I pull up the chart here to mention that if you want to get super powered book summaries, check out Shortform. A really great way to inspire you to potentially check out the entire book. Like, for example, one of my favorites is this book called Good to Great. Really, actually phenomenal book, especially if you're trying to run a business. Really excellent. Everybody should read the book Good to Great. But if you wanted to start with a super powered book summary, go to shortform.com/meetkevin. Their sponsor, link down below. I think I pressed that button. Yeah, there we go. Anyway, go to shortform.com/meetkevin. Check them out. All right, so let's look at the actual charts here. Now that we got this up, I want to see where numbers are going down. And let's quickly also see here, seasonally adjusted change, 1 month percent change. So we want to look at the far right column in this one. So far right column, what do we got here? Durable consumer goods, 0.2%. Those are like appliances. Fine. Final demand services. Oh, thank goodness. Look at that. That's what I want to see. This is what you want to see. Look at this. Final demand services. This, by the way, has a 66% weight. I'm pretty sure. Hold on. Let me make sure that's the weight. Relevance. Yes. Okay, good. Look at this, folks. 66% weight of PPI is final demand services. And finally, for the first time in at least the last 3 months over here, I think we could even go back to 4. Let me double check. Oh, look at that. 1, 2, 3, 4, 5. 5. We can go back 5. For the first time in the last 5 months, we've actually had a negative read on final demand services. Thank God. Final demand trade services, negative. Finished goods, negative, 0.7. And these are big negatives too. Look how negative this is. This is finally starting to make it look like inflation is starting to be transitory. I know people are like, that's a terrible word, but it's finally coming true because look, what happens is first PPI falls. Then you have to remember there's a big lag, and then it shows up in CPI. Because when the production prices come down, then you don't have to raise prices as much. Not even that you could raise prices as much because people are demanding less. But anyway, there's a lag between the two. But this is fantastic. So final demand services in aggregate down 0.3%. That's awesome. That's literally 3.6% deflation on an annualized basis. That's wild. Final demand trade services minus 0.9. I mean, think about what 0.9 means. 0.9 on an annualized basis is negative 10.8% deflation. Prices actually coming down. Trade of private capital equipment. Like, this is like machinery right here. You want machinery right now? Coming up for sale, baby. Minus 2.4% on a month. Government purchase goods down 2%. Look at this. This is insane. Minus 4.8% trade of government purchase capital equipment, trade of exports minus 1.5%, final demand transportation and warehousing services minus 1.3%. But still, passenger transportation. So it's people, right? People are still spending money, but not on stuff. So this is where we are seeing some of the stuff, some of the items, but it's interesting that in the services for goods, that's where you're seeing a lot of these negatives. It seems to be. All right, let's see what else we got here. Let's see, transportation, lots of transportation. You got some mixed reads over here, but a lot of this transportation stuff is actually negative. Oh, that sounds like Mario. Here, anything with passengers is positive. Okay, fine. What do we have here? Final demand services, less trade, transportation, and warehousing. Okay. Finished consumer services. Only 0.2%. Well, that's good. Final demand services, less trade, transportation, warehouses, 0.1%. That's fantastic. That's really good. Okay, well, I like to see that. Final demand construction, 0.2%. Fair game. Totally fine. There's nothing scary in this report at all. This report is freaking awesome. This report is great. It's a me. Final demand, less exports, negative 0.5%. Final demand, less government, negative 0.5%, blah, blah, blah. Okay, this is, it's so negative. It's crazy. Final demand, goods, less energy. This is the highest thing I've seen here, 0.4. But that's interesting, 24.8%. Final demand, goods. Goods, less energy. So, energy really tanked a lot of this, it seems. But energy is not going to tank your services. This final demand services over here. But it would make sense that it would tank some of your goods prices. But then again, even in aggregate, what did we say? Without energy, we're looking at PPI X food energy trade 0.1%, X food and energy negative 0.1%. Yeah, that's fine. Okay, what else do we have here? Let's see here. Finished goods, finished services. See, look at that. Finished services. Negative 0.2%. Yes, very good. Finished goods excluding foods, negative 1.8%. Finished goods excluding energy. So if you only exclude energy, it's interesting, 0.6. But then, so if you only exclude energy, does that, it looks to me like foods then really pushes this up. So maybe foods are what in goods push this up. Because when you do goods minus food, you get negative 1.8%. If you do goods only minus energy and not food, you get 0.6%, which is pretty high. So that suggests food really popped up a little bit. should be able to see that a little bit more clearly here somewhere. We'll keep looking for it. All right, total finished, less foods, minus 0.5, less energy, flat, fine. An aggregate of all, 1.2, okay, good. Total exports, goods for export. All of this is negative. And just look at this. You don't even have to read it anymore. It's just all plummeting. All of it. Personal consumption, negative 0.4%. What else here? Yeah, as soon as you take out food, look at that. Personal consumption of goods, less foods, negative 2.9%. So foods must have had a big pop there to weigh this up so much. Processed goods, manufacturing for foods, manufacturing components for construction. Construction's still getting a little boost here, 0.5%. Okay, unprocessed goods. These are feeds for animals. Fine. A lot of these numbers will be up for the energy products next month because of the volatility of oil. But that's okay because once we look at less energy, you're still looking at good. No, but that's interesting. Oh, these are stage 4 goods because here food is negative. It's a little bit more of a complicated report. See, here we go. Inputs to stage 4. There we go. Foods. Yeah, foods were up a little. Okay, that's fine. But foods are one of those volatile ones, and that's why we generally say X, food, and energy. Because on a month-to-month basis, these things are flying around. And again, what's more important here is seeing some of these services start coming down. Trade services down 0.1%. Services across the board, 0.5%. Except for passengers. That's one part that's moving up. Okay, anything else? Let's see if there's anything that really stands out over here. No. Stage 2, looking for something that stands out. Services, passengers, energy. We know energy fell a lot. Stage 1 food fell 4.4. Okay. Inputs to stage 1 service producers, foods. Yeah, there are definitely some parts of foods components that were hot in this one, but beyond that, this is all negative here. This is pretty remarkable. Wow. Okay, that's really great. So that gives us our PPI numbers. Now, what I'd be curious to see is how the Fed rate monitor is moving as a result of this. Let's see here. All right, Fed rate monitor. All right, let's see what we have. Rate monitor right now is looking at a 69% chance of a 25 BP hike in May, and then we're looking at a 67% chance of a freeze in May, or sorry, in June. So in other words, hike in May and go away. Some people are starting to price in with a 28.6% chance that we get a 25 basis point cut, or that we actually have frozen in May and then stay frozen for June. Indices now turning slightly positive. Dow up 13 basis points, S&P 22, NASDAQ 36. 10-year Treasury sitting at 3.39, so down just a smidge here. And oil's down about 0.5% here. So what does this really mean for the Fed? Well, let's see if we have any commentary from Wall Street on this. I mean, in my opinion, this is fantastic. This is exactly what the Fed wants. The Fed does not want to have to create a recession, but they will if they have to get rid of inflation. And that's always something you want to remember. They will force a recession if they have to get rid of inflation. But are we, is it necessary to create a recession if inflation goes away? No, of course not. Then they turn the money printer back on. PPI provides dovish surprise. The claims data was broadly in line with expectations for initial filings. More notable, however, was the unexpected decline in PPI, which undershot expectations by a considerable margin across every aggregate, falling 0.5% on a headline basis. There were some upside revisions to prior data. Correct, I went through those. But in aggregate, producer price inflation looks a bit lower than expected. That would provide another argument in favor of an end to the Fed cycle coming shortly. Though, given some of the trends in energy prices, it may well be the case that PPI starts ticking higher again soon. Well, yes, we talked about that. Brent's up 10%. Sorry, not 10%. It's up a little bit more than 10%. Brent's up like $10, right? So, I mean, you're up like 13% on oil month over month right now. But That's why we look at these numbers excluding oil. So next month is going to be a little bit more granular, where we'll have to go through a little bit more and go, okay, so that's related to oil. But that should be pretty obvious. Yields drop on PPI data in headwind $4. Yields dropped on data. Meanwhile, jobless claims were pretty much in line. PPI below expectations, right? Let's see here. What is this? A pervasive deterioration in consumer in continuing claims data across the United States is consistent with a recession beginning very soon. I didn't see the jobs claims data actually deteriorating. Let me see here. Initial claims came in 4,000 higher than expected, but continuing claims fell from the survey and from the prior report. The survey was 1.833. The prior release was 1.823. The actual was 1.810. So what do they mean a continued deterioration here? A pervasive deterioration in continuing claims data across the U.S. is consistent with a recession beginning very soon. Historically, a recession should mean stocks making new loans, but this cycle is proving odd, and this should not be taken as read. A very reliable and a very rare technical signal points to a long-term constructive outlook for U.S. equities. Very reliable and one very rare. Okay. This is why. Can they not write English here? Hold on. Percentage of continuing claims has never hit this level and not gone on to spike much higher. Oh, I see what they're saying. Okay. Here, let me show you a screenshot of this so you can see what they're talking about. Okay. That's not necessarily from this percent of the United States. Okay. All right. Fine. So let me pull up. I press this button. Yeah. So here's the chart that they're showing. Percentage of U.S. states. So this is a percentage of U.S. states. So this is very different from the headline number, but it's a percentage of U.S. states with an annual change in claims rising 30%. So as soon as you get more than, 18% of states seeing continuing claims rise over 30% on a 4-week moving average, as soon as that goes above about 18%, you've always seen it rise substantially higher, is sort of the argument they're making. We're basically there right now, which is quite interesting on continuing claims. But I want to understand what they're talking about here with this. One very rare technical signal points to a long-term constructive outlook for equities. Why? Let me click it. Let me see what this is. Rare buy signal hints that worst is over for stocks. Let's talk about that in another segment. So let me give a quick summary here on PPI, and then we'll talk about that. So quick summary here. PPI, look, PPI was great. PPI was great, and your PP-related stocks should be very happy today. Any kind of pricing power stocks should be very happy today because your input costs just went down. I think this, once again, reiterates the Fed 25 BP in May, and then pause. And they're going to pause for a long time until inflation is convincingly dead. But that's okay, because the longer they pause, the longer we're not in a recession. And the longer they're paused, the longer inflation isn't a problem. Think about that. The pause on both sides is good. Pause rate increases, inflation, no problem. Pause and not cut, no recession. So you want to pause and kind of hang out there as long as possible. That's your most optimistic scenario. So very excited about that. Let's get into the next segment. So thanks for watching the PPI segment. All right. Let's now talk about rare buy signal. Oh! Kevin, loved your video on life yesterday. Oh, thank you for that. Same, pumped me up this morning. I pumped Steve? I'm honored. No, well, thank you for that. No, it was sincere. It was, I wanted to just share some. We're always talking about these numbers and the, like in Wolf of Wall Street. It's all the granular. And I think it's good to talk about reality too sometimes.